From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 11th, 2024. Let's check the calendar. Sunday, the Packers are home with the Arizona Cardinals at Lambeau. The Bayview Bash is this weekend, and the public market is throwing a harvest fest. They're celebrating their 20th anniversary. Sunday, it's the annual Cheese Curd Fest at Frink, Wisconsin, and for kids of all ages, it's Monster Truck Weekend at Fiserv Forum. All right, the latest news from the Hurricane Milton. Disney World in Orlando has reopened this morning. You just can't shut down the happiest place on earth. A terrified Oregon woman was forced to flee after a man broke into her home and cleaned her floors, took out the trash, and helped himself to her wine. My wife said if I cleaned the floors and took out the trash, she'd be terrified too. And speaking of terrified, a woman in Washington would routinely feed raccoons in her yard. Well, the word got out on the raccoon telegraph, and she was surrounded by over 100 raccoons, all demanding food. She had to call the cops to be rescued. The police are very quiet about how they resolve the situation, but my guess is there are now fewer than 100 living raccoons in that yard. And finally, let's go to England for the next bit of silliness. England's Law Commission has proposed reusing existing graves and reopening burial sites to address the shortage of space for burying people. I guess you could always use the bunk bed approach. On the podcast today, we have Tom Pappenfuss, Joel Dresang, Mike Helsel, and wrapping up the week, here's Kyle Teding.
Well, thanks, Max. Another good week in the books for the markets. The Nasdaq up 1.1% this week, up 205 points. The S&P 500 up 1.1%, up 64 points this week. And the Dow Jones Industrial Average added 410 points on Friday to close the week, up 511 points. That's 1.2%. For the year, including dividends, Nasdaq up 22.8%. The S&P up 23%, and the Dow Jones Industrial Average a pretty stellar 15.2%. You know, Joel, I think maybe we'll get the public service announcement out of the way early here. We got our update for those on Social Security on what kind of gain they should expect in terms of cost of living adjustment for next year, considerably lower than what we've seen the last couple.
Yeah, and that's a reflection of the Fed, having some success at lowering in the inflation rate. So that's what this is based on. And the Social Security Administration came out this week and said that next year, in 2025, beneficiaries can expect 2.5% increase in what they receive. On average, I guess that averages out to be about $50, but it varies by person, of course. So that 2.5% is down from a 3.2% raise this year, and last year was the highest in 40 years. It was 8.7% in 2023. Again, that was reflecting the high inflation rate in 2022.
We made the point in the seminar this year of talking about the kind of increasing rate of those entering the rolls of Social Security. And as the number of folks that reach 65 and kind of think about retirement grows, I think it's clear that if you have another $50 in your pocket, well, that's $50 more that supports potential spending. Tom, I know we look quite a bit at kind of the consumer piece, and I think the point that I was trying to make in the seminar is, okay, well, now you have another more than 4 million people entering age 65 this year, a point in time in which a lot of people think about that retirement transition to begin with. But maybe one more reason potentially why the consumer's in pretty good shape.
Yeah, I think you're looking at where the consumer's at today with some of those demographic changes. As you mentioned, a large amount of people are heading towards retirement. And generally what we'd expect is, a fair amount of them are going to be spending a bit more, especially as you first open the doors to retirement. You've got that freedom and that time to finally do the things that you're hoping to do. And naturally, people take the approach that they want to do things while they're healthy, able-bodied, and want to kind of, get those things under their belt and take advantage of them. So it's a good sign for the overall economy, for markets, that you tend to see spending to pick up in that sense.
Yeah, and I think you make an important point that especially early retirement, we tend to see a considerable amount of activity, whether it's watching kids and grandkids, whether it's going and traveling and doing all the things you couldn't do while you were working, or whether it's just simply finding ways to contribute in your community. It's not as if you're suddenly just taking yourself out of all the things you used to do. And so I think, if we've got a nice little bump in Social Security on the back of what had been some prior higher rates of increase for cost of living adjustment, one more thing that potentially contributes to our ability to spend. And then, Mike, we're talking about now a bull market that as of tomorrow is running on 2 years. And so it's not only that retirees see a little bit of a bump in their Social Security, that maybe their homes are worth more and so they feel a little wealthier, but also that their retirement savings have gotten a nice bump from this bull market.
I brought that up to you as something to talk about today because I found it interesting, just some statistics on it. I always try and be the bearer of good news here on the podcast going into a weekend. But I found it very interesting that we're talking about this bull market that you said is about 2 years old this month. But a lot of consumers, our clients, don't even realize it or are always waiting for like the next bad shoe to drop, right? If there is a bad shoe, kind of a clumsy phrase there, but you guys know what I'm talking about. And so I found some statistics that I've been sharing with clients that I thought I'd kind of share with the broader group here that I thought was interesting. So if we're about 2 years into this bull market, right, since 1950, the average bull market's about 5.5 years. And in that 5.5 years, it gains 180%. Now, again, not saying that's going to happen here, but that's kind of the averages. And then stocks have been up 10 of the past 11 months, right, to the point where even some bears, JP Morgan, are even having to finally admit, and this is one of my favorite headlines of the week, I wrote it down here, there's a chance of an upswing in stocks. With all due respect to JP Morgan, where have you been the past 2 years, okay? So, and this one I thought was kind of interesting. So 5 of the past 12 bull markets have started in October, right? When this happens, the fourth quarter of the second year usually sees a 5% gain. So basically, on historical averages, we could see another 5% gain in stocks the rest of this year. And so I just want people to say, like, listen, even though you might not be feeling it right now, because I have a lot of clients come in and be like, how am I doing? Because there's just, with the election and everything and a lot of negative messages out there that either party is going to sink the economy, that things are pretty good. And now you're starting to see kind of the benefits of that. You're seeing markets up, what are we talking about, 30% or so over the past 2 years? And so the reason I just wanted to bring that up was because on the back of the lower COLA numbers, that there are some good things ahead, that people should not always look at the downside or not always remember the flashing red numbers or the negative message, that things have been pretty good for 2 years, and there's a good chance with all the things going on in the economy, they could last a little while longer. Not saying they're going to, but there's a pretty good chance they could.
And of course, I think it's fair to point out that even amidst what's been a great stretch, we've had some bumps along the way. That, kind of 3 meaningful downturns in the last 2 years. One caused by the potential for a pretty meaningful banking collapse going back to March of 2023. Some inflation scares this year that took markets down temporarily, and yet here we are 2 years later, still running pretty hot in this bull market. And I think it's fair to say there's plenty of uncertainty ahead. And so it's why when we look at stocks that are a little expensive, when we look at the potential for political uncertainty, geopolitical risk, there's reasons to be cautious, even as kind of the longer-term view is pretty optimistic.
I would even add, I think the other part that, of the many things you can like about this market and this market run we've been on is that it isn't the most well-liked. It's not an irrational, exuberant market. Looking at data for fund flows, I believe the leading asset category in the last few weeks has been money markets. So it tells you that there's still a lot of skepticism, a lot of uncertainty, and that just tells me that there's still more room for money to come back into this market. And I think as we talk about the election, we all have clients that are nervous, and rightfully so. We have personal reasons for that. But that money, if it was earmarked or meant to be longer term invested, I kind of tell clients that money could come back into markets. I think that money is there, and maybe perhaps people want to go a little bit safer for the time being. That money could find its way back in, and so there's more legs yet for this. I try to look for downsides and be a little bit of a contrarian. It's just part of me, but there's a lot of positive data points yet.
And the reason I say this is not necessarily to tell people to go kind of like whole hog into stocks right now. It's just to kind of, because sometimes in our day-to-day lives, you don't necessarily get the 30,000-foot view of where we've been, possibly where we're going. And so I just tell them more of this, I tell them this to say, I have some clients that really want to go in a protective crouch right now, almost to the point of get out of the market. We don't know what's going to happen. We want to go into, say, 30% stocks, 20% stocks. And I'm like, well, if you do, there's a chance you're not going to be able to keep up with inflation, or for the people that just retired, your current spending patterns. But if you are in the balanced portfolios that we talked about, as Kyle, you so astutely talked about at the seminar, which is really good people, that you can keep up with inflation just by being in a balanced portfolio, and stocks have done well and may continue to do well.
Maybe the other kind of big news this week to kick off of earnings season, Tom, we got some bank earnings late this week, but really get into the heart of earnings season over the next couple. And I think the things I'll be most interested in are things like what it means for the consumer, right? How much are the retailers having to discount versus being price takers before? What kind of headlines are we really seeing in terms of expectations going forward? What have you seen from kind of the earnings picture so far, and what are you looking ahead to?
It's been surprisingly good. I think we kind of look at the big banks as almost a window view of where's the economy at and where is it going, because they have that view of lending, they have that view of credit, and how the overall health of the consumer. And so we have J.P. Morgan this week. We had Wells Fargo reported very good earnings news. So we've seen them jump up. I think BlackRock, if I'm not mistaken, was also reporting. So of the financials, so far it's been a good start to the earnings season. And like I said, for that reason, they especially Jamie Dimon, who's talked about, and he's been, would you say, kind of a bearish take on this? He's talked often about stagflation, and that's being a big concern for him. I think his quotes, and Kyle, you shared that he talked about, well, I think we've softly landed, so to speak, and so he's kind of finally embracing and recognizing the data that's out there and been out there. So a bit of an about face for someone that has, been more pessimistic, and perhaps a little bit of what we might see in the coming weeks ahead.
Well, and I think I'm always more cautious with regard to what J.P. Morgan has to say because of how much data they have on consumption. Odds are, if you have a credit card, you've got a Chase-branded credit card. Odds are, if you're a banking customer, as almost all of us are, you interact with Chase in some form or fashion, just given the size. And yeah, that's not true in aggregate, but when you break down the numbers, a lot more of us interact with Chase than don't. And so I think if they're talking about an economy that's maybe a little bit more cautious than optimistic, then I'm probably looking at that and going, okay, maybe there's a reason why they're saying that given what they know. And when they're talking now about, okay, maybe the soft landing really is here, well, I think what they're saying is, yeah, we've seen the slowdown. It doesn't mean it's not going to slow down a little more, but at least the data we're seeing now is that, yeah, this is a place in which we can be comfortable that the bottom's just not going to suddenly fall out all of a sudden. And so I'm encouraged by comments from the banks this week. Again, I think my kind of general reading of the tea leaves will get a little clearer next week and the following as we get more data from all these businesses that were some of the leaders in, we call it price taking, right? The ability to jack up prices along with inflation. Well, how much do they have to back off now? And we've seen some of them already. IKEA saying, hey, by the way, we got to back off on some of those price increases. And in many cases now actually price cutting because they're recognizing, hey, inflation isn't the boogeyman that we were able to point to before and blame. Now we actually have to be competitive again. And so I think a good sign for me that potentially inflation is becoming less of a problem. And Joel, we got both the producer price index number, which is a little bit more leading, and then the consumer price index, which I think tells us a little bit about the current state of the inflation picture.
Yeah, that consumer price index is the broadest measure of inflation, and that ticked down again in September to the lowest point it's been in more than 3.5 years. And again, a lot of the headlines in financial publications were, oh my goodness, it's at 2.4%, and analysts were expecting it to be 2.3%. So it's a lot bumpier than we expected, or it's not as briskly, decelerating as we expected. But it still was a pretty good report, and it's showing that what the Fed did with raising interest rates and trying to to tamp down the economy a little the last year and a half, that's had some effects, and it's probably too soon to say soft landing, but we're not in a recession. There aren't real strong signs of a recession, so that inflation rate has come down closer to the long range 2% that the Fed has set. And it's interesting looking at that CPI number against the University of Michigan Consumer Sentiment report that came out today, because people in that report are acknowledging that inflation is coming down, and that's less of a worry for them. Yet they're complaining about prices, and high prices are something that they're concerned about, and that is putting a damper on how they feel about current economic conditions. One of the things from the CPI that I found interesting was, so the price of eggs went up 8% in the last month. And that's been a real, and so I looked at, the Federal Reserve Bank in St. Louis keeps track of data, and they have $3.82 for a dozen of grade A large eggs in the latest report. And that was 20% lower, 21% lower than when it had peaked in January of 2023. So the price has come down. But it's more than 3 times what it cost just before the COVID pandemic. Now, there are other factors in there, because we had the avian flu, which actually cut out a lot of egg-laying hens. So there are other things going on there. But a lot of people, when they look at something like that, you can just sort of take that one thing and say, oh my gosh, things are so expensive. They're less expensive than they were a year and a half ago, but they're more expensive than they were a couple of years ago. And then I also looked at this. So the relative importance of a dozen eggs in the overall consumer basket, as the Bureau of Labor Statistics looks at it, is like 1/26th of the importance of a gallon of gasoline. And gas has been coming down, as we all know, as we drive around. But we can all relate to that too, because we buy more gas than we do eggs.
Well, you try to fuel your car on eggs and tell me how that goes. But as the father of a child that would eat eggs for breakfast, lunch, and dinner, I'll tell you it's a little more important in my house than maybe in others.
Hulk Hogan might have something to say about that too.
And I think all of that speaks to the real challenge we always have in talking about inflation, right? That it is a much more nuanced number than anyone is willing to admit. And even when we get back to a conversation about eggs growing at 2% instead of 8%, or gasoline going down in price, forget for a second what the basket looks like, right? Forget how we're measuring all these things. In aggregate, 2% inflation doesn't mean prices went back down because the Fed's target was 2. It means, oh, by the way, they're not going up at 8 or 9 or 10 anymore. And so I think there is just so much misunderstanding about what inflation really is, how it's measured. It's why it's so easy for our news media, our politicians, our neighbors that want us to believe something other than what's true. Hey, here's what's actually going on with inflation. I think, it's why when we talk about it, we try to pick the same few data sets. We try to be clear on here's what we're measuring, how we're measuring, when we're measuring. It's why when we look at some of the more volatile measures, I've been interested in seeing what the Fed has been doing. More and more Fed governors talking about kind of month-over-month change on a rolling 3-month basis as a way to say, hey, there's a lot of volatility in this data, especially month to month. If you start to stretch it out a little bit, all right, we get a better idea for the general direction. That number right now on headline CPI is about 2.1%, rolling 3-month, month-over-month changes. And so I think on an annualized basis, it's a sign that, inflation continues to creep down slowly. It still matters how you measure. It still matters whether you eat more eggs or broccoli in your house, because the prices are always going to be impacted by different things.
I remember I said some clients go, well, yeah, things are more expensive now than they were. They said like in 2010. And I was like, yeah, that's how it works. Cost of things go up, cost of labor goes up. Like that's just how things work. Prices are going to go up. Now it's going to, for different reasons. As you said, eggs go up because of avian flu, but I still hear, even on like online or in the news, people saying, well, compare it when George W. Bush was president, they're just picking a time, to now. And I'm like, well, of course prices have gone up over the past 16 years. That's just how things work.
And Mike, the other part of that equation is that their incomes and their net worth
Have gone up
I
as
hope
well.
have also gone up since 2010 as well.
If they've been
Yeah.
with us, they've gone up.
Household net worth is at all-time highs. So, I mean, the consumer is technically in a better position to handle some of that.
Which, Joel, as you brought up the consumer sentiment number, which I thought was interesting because, things overall are pretty solid economy-wise. And I'm very fascinated by like why people think the way they do. And when I looked in the consumer sentiment number, a lot of them, it came down to two things for a lot of people that have like, I don't say a negative view of it, but a less than rosy outlook. And a lot of them were like younger respondents, like high cost of living. And the one that doesn't get talked about a lot is like the high cost of daycare. And they said those two things are like really weighing down on a lot of younger consumers. I mean, I talked to my client the other day, they're currently paying for 2 kids $26,000 a year in daycare. So they can do it because they're doing very well, but for a lot of other people, you just can't. So that's going to weigh on your sentiment of the economy in your, particular prism.
Joel, not a terribly busy week for economic data, but we did get one more kind of consumer-focused number in revolving consumer debt. I don't generally put a lot of stock in, especially month-to-month changes, but a little bit of a decline in outstanding consumer debt, maybe a sign that consumers are a little less willing to spend on their credit cards right now.
Maybe getting back to Jamie Dimon and what they're seeing is consumers being a little more cautious. So, and that's a number that you can interpret different ways, but it's basically the amount of outstanding debt that people have on their credit cards. And so for the second time in 3 months, so we're not looking just at 1 month, we're looking at more of a trend, that's gone down. And that's rare that goes down. It usually goes up every month.
As you'd think it would if the size of our economy grows, if people have more money, it would make sense that there might be a bit of a higher debt balance overall in credit cards because there's more asset behind it to support it.
And it's more confidence that they can, have that debt and take care of it.
Yeah, that's the hope, right? That consumers feel healthy enough at a time in the year in which we tend to get the biggest chunk of consumer spending now coming through the holiday season. The hope is that the soft landing stays intact here, that the banks so far that have reported and somewhat optimistic about the outlook ahead are right, that we get some of these consumer stocks coming through in the next couple of weeks that maybe echo some of that sentiment, and then I think I've got a little more confidence about how we finish the year. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.